Think back to the last time you sat down to do your taxes. You're looking at that final number on the screen and you feel that sinking realization. The game ended months ago. When you're sitting down to file your taxes, the actual outcome has already been decided. Your opportunity to influence the numbers is past. It's frustrating, it's repetitive, but what we're going to talk about today is how it's avoidable. Today, we're stopping that cycle. We're talking about the massive shift from simply reporting the score to actually setting it. This is the difference between tax preparation and tax planning. Welcome back to the Retirement Switch. I'm Garrett Borbina. Now, most people approach tax season with a sense of dread, wondering what the damage is going to be. They're just waiting to see where the chips land. But as a certified financial planner, I'm here to tell you that you don't have to be a spectator. Today, we're breaking down the massive difference between simply reporting your taxes and actually planning them. Let's get started. There are four distinct differences when comparing tax preparation to tax planning, and those are timing, focus, nature, and objective. And we're going to start with the preparation side. The timing of preparation is seasonal. Most people only hear from their tax preparer once, maybe twice a year, usually between January and April. It's a snapshot in time when you're gathering documents for a year that has already passed. It's an annual appointment rather than an ongoing discussion. Second, we have focus. In the preparation phase, the number one priority is getting the math right. We want to ensure every digit is in the correct box so you don't trigger an IRS audit. Accuracy is vital, but the downside is it's not forward-looking, which leads to number three, nature. This is the most important part of preparation to understand. Preparation by nature is reactive. A tax return is essentially a history book. It reflects decisions that were made months, maybe even a year ago. Once the ball drops on December 31st, the IRS effectively freezes the frame. At that point, your potential to influence the outcome is essentially none. Lastly, we have the objective of tax preparation, which is to avoid penalties. Many people think the objective of tax prep is to lower their tax bill. I would actually disagree. By the time you've started prepping for your return, your bill is already set. The true objective of preparation is to stay in the lines, avoid penalties, and keep the IRS off your doorstep. Now, you may have noticed a trend here with these responses. A tax return is like looking in the rearview mirror. While important and a vital part of somebody's financial plan, we need to pay much more attention to what's in front of us rather than behind. If tax preparation is the rear view, then think of tax planning as the headlights. It's helping us pierce through the fog of your future. Now we're going to switch gears to tax planning. Now, the timing of tax planning is year-round. When I say that, I'm not just talking about a calendar reminder. I'm talking about an active, ongoing process. For our financial planning clients this past year, we didn't just check in once. We used a comprehensive tax planning checklist, about 35 different strategic points to constantly monitor and influence the outcome of their returns. Think back to last year with the changes brought on by the big summer tax bill. For a lot of retirees, that bill gave people additional wiggle room for really great tax impacting strategies. If we would have concluded our planning in the first half of the year, you very well could have left some tax opportunity still on the table. If you're only talking to your tax person in April, you're trying to navigate a ship while looking at a map of where you were 6 months ago. Real tax planning is about having your hand on the wheel all year long, adjusting for the wind and the waves as they happen. Next, we have the focus of tax planning, which is to strategize. In tax planning, we're looking at the road ahead and determining how we can most tax efficiently get from point A to point B. It's a lot like using a GPS. When you plug in a destination into your phone, the GPS has one primary objective: getting you to your destination in the most time-efficient manner possible. It's looking for traffic, construction, and roadblocks so it can reroute you onto the fastest path. That is exactly what we're trying to do with your taxes. We know where you want to go, whether that's a comfortable retirement, leaving a legacy, or maybe it's selling a business. Our focus is to find the most tax efficient route to that destination. If you're planning to leave a legacy to your family and you're not factoring in the taxes that they will have to pay down the road, then you're basically trying to use a GPS that's not factoring in the traffic. Yes, it might be a road that gets you to the destination, but it's no longer the most efficient route possible. Switching to the nature of tax planning, we have proactive. This one was probably pretty easy to guess because we've already hammered home the forward looking nature of this work. In preparation, the nature is reactive. You're responding to things that have already happened. But in planning, we're influencing the outcome. Whether we're shifting income into a lower tax year, harvesting investment losses to offset gains, or timing a house sale to make sure we receive preferential capital gains treatment. We are taking action while the calendar year is still open. Lastly, we have the objective. In the preparation world, we were just trying to avoid a penalty and get the forms filed. But in the planning world, the objective is to minimize the tax impact on the life of your assets. Now, I chose those words very specifically. For some, the goal is to spend everything they have during their own lives. For others, the goal might be to leave something to family, friends, or a charitable cause that's close to their hearts. The reason we focus on the life of the asset is because it covers all of these scenarios. If we only looked at the tax you would pay while you're still alive, we could be creating a tax trap for those that come after you. Take a look at what happens when you pass on a traditional IRA to your kids. Let's say you have $1 million and 2 kids. Each kid is inheriting $500,000 in the form of what's called an inherited IRA. Now, for each of those kids, the IRS mandates that the accounts have a zero balance within 10 years. This means that the 10 years after your passing, your kids are essentially taking a second income. If they're in their peak earning years, they could be taxed upwards of 40% depending on where they live. Now, that is the definition of a tax bomb. You worked hard to create that legacy bucket, but because you didn't look at the future taxes and the life of your assets, the IRS just became your silent heir. This is why we look forward at the big picture. Whether it's choosing which accounts to draw from first to keep your heirs out of the higher bracket, or using tools like Roth conversions to leave a tax-free legacy, the goal is the same: to ensure that the IRS doesn't become the primary beneficiary of your life's work. If you do not currently have a financial planner who actively plans for your taxes year-round, I strongly encourage you to find one that does. Don't risk only looking in the rear view when driving on the highway. If you want to learn more about how Landing Point integrates deep dive tax planning into our full financial planning service, go to our website, landingpointfinancialgroup.com. Next week, we're going to continue this tax deep dive. I'll be walking you through the specifics of my 5 best practices for tax planning so you can see exactly how we diffuse those tax bombs we talked about today. Thank you so much for joining me. If you found this helpful, I would love if you gave this video a like and hit that subscribe button to ensure you do not miss the next one. I am Garrett Borbina, and this is the Retirement Switch.